Hey y'all, welcome to the third Rich to Wealthy podcast episode. My name is Steven.
And I'm Mark. And today we're going to continue our series on frequently asked personal finance questions.
Okay, great. So last time you interviewed me. And so how about this time I interview you?
Sounds like a plan.
Okay. I was thinking we'd talk about 529s. So if that's okay with you, why don't we start out with you telling me and the audience what a 529 plan is?
Sure. So 529s are a tax advantage way to save for educational expenses. It's based on the Internal Revenue Code section 529. That's where they get their name. And it's a tax advantage way to help incentivize people to save for future child expenses with education.
Okay. And so my understanding is there are two types of 529.
Yes. So the two types of 529 plans are educational savings plans and prepaid tuition plans. Educational savings plans are ways that you set up an investment account and then you can withdraw from that investment account to pay for qualified educational expenses. That's the first type. The second type is a prepaid tuition plan. And that is just like the name says, it is a way to lock in the rates of tuition at your institution or state's institution, depending on the plan, at today's rates and pay it now.
Okay. So why don't we spend the rest of today talking about the educational savings plan type of 529s?
Sounds like a plan.
Okay. Sounds like an educational savings plan? Okay.
Yes.
All right.
Okay.
So we talked about what a 529 is. What about why? I know you've already covered some of it, but why would you contribute to a 529?
There are two main benefits to saving in a 529 plan. The first is the tax benefits, and the second is the flexibility that it affords. The tax benefits are essentially twofold. The first tax benefit is you're taking post-tax dollars and you're placing it into this investment account, and the investment income and increase
in the earnings.
Increase in the earnings are tax free. Okay, so that's the first advantage.
Okay, so the money you put in, even though it's post-tax, which is not a benefit, is growing tax-free. So that's the first tax advantage.
Yeah.
Okay.
And the second tax advantage is that when you're ready to withdraw it and you use it for qualified educational expenses, that withdrawal is also tax-free.
Okay. You put it in, you have to pay tax on it first. It grows tax-free, you take it out tax-free.
Yes.
Okay. If you're using it for qualified educational expenses. So can you talk a little bit about what those are? Yeah.
So qualified educational expenses would be things like tuition, okay? And then you can use tuition for K through 12 schools. You can use it for vocational schools, and then you can obviously use it for college and graduate school. Okay, so that's a first qualified expense. Second would be room and board at your vocational school or college. And then the third would be things like computer, books, and other associated educational expenses.
Okay, so you said tuition and fees. What were the others?
Room and board. Computer.
Okay, computers and stuff like that. Okay,
yeah.
And then a few other things, right?
Yeah.
Okay. So we talked about what it is, why. What about who? Like who would set it up and who is it for?
Okay, good question. So anyone can set it up, and anyone can pretty much be named as a beneficiary. Okay, so you could even name yourself as a beneficiary. That being said, it most frequently is used to save for your children's for educational savings.
Okay. Makes sense.
Yeah.
Okay, so that's who. And then like when would you do this?
So most people would start this plan, at the birth of their first child. But grandparents could set it up for their grandchildren, or there are a whole host of different scenarios where you could plan to do it. But that being said, as early as possible is best.
Okay, because time in the market
is better than
timing the market.
Yes.
Okay. All right. So we talked about what, we talked about who, we talked about why, we talked about when. Okay, so there's where and how much. So how about where first?
Where? So these plans are held at different states, okay, by different states. So every state generally has a plan or more than one plan. So you just have to look at the different plans. You can invest in any state's plans. And also, you just want to make sure that, depending what we were talking about before, the two different types, the educational savings plans versus the prepaid tuition plans.
Okay. So if you live in a certain state, do you have to contribute to that state's plan?
You do not. You could contribute to anywhere. The only tax advantage, which is a third tax advantage of these plans, is that if you are a resident of that state, sometimes those states can give you a state income tax deduction based on your contribution.
Okay. Oh, that's great. Okay. So I know in Virginia and in Maryland, there are some state income tax benefits to contributing to those states' plans if you're a resident of those states.
Yeah. And you can check the state's rules based on your location.
So for example, I think California doesn't give a state income tax deduction for contributing. So a lot of Californians would contribute outside of California. Is that right?
Exactly.
Okay.
Yeah.
Okay, cool. So let's see. The last thing is how much?
How much? So there technically is no limit on how much you can contribute to one of these accounts, although some states put a cap on lifetime contributions. The way to think about it, though, is also there's this annual gift tax exclusion because these essentially are gifts to a beneficiary. And so the maximum amount or the annually for a gift tax exclusion is $17,000 currently in 2023. So, ultimately, if you were going to give more than $17,000 per year to a beneficiary, you would have to file a gift tax return. Okay.
And then I've heard something about super funding. Can you talk about that?
Yeah, sure. That's a little bit more nuanced way to fund a 529. And essentially what it is that you are taking 5 years of annual gift tax exclusion and funding your 529 plan all at the same time. And the government does that as a way to, again, encourage people to do tax or to do educational savings for their children.
Okay. And so if you are a single parent, you would do 5 years at a time, potentially up to 5 years at a time. And if you are married, you're two parents, you could do twice that much?
You could do twice that much, yeah.
Okay, well, it's really super funding.
Yeah, exactly.
Okay. All right, and the reason you do this is because time in the market
is better than
timing the market.
Yes.
Okay, all right. Okay, so that's pretty much all we wanted to cover today, I think.
Yeah, I think so.
Okay, you want to do our outro?
Why not?
Okay, go.
All right, so if you like this, please hit the like button, please hit subscribe, and check us out on our Instagram, Facebook, and our website at www.richtowwealthy.com.
Hey, what about Twitter?
Why not?
Okay, Twitter too.
Thanks, guys.
All right, I'll see you next time.
See ya.
This episode contains general financial education and advice. Always consult a competent and trusted financial advisor, attorney, accountant, or other professional counsel to discuss suitability for your specific situation.